Hey, folks, welcome to InTheMoneyStocks.com's live trading action video. My name is Gareth Soloway, Chief Market Strategist here. Today's date is Tuesday, November 10th, 2015. All right, take a look at Apple today. Apple's taking a nice hit today, down about $3.40. 2.8%. What's going on here? What are we seeing in the charts? And again, if you know anything about in the money stocks, you know we're strictly chartists, all about the PPT methodology, price, pattern, and time. So let's start out by going to the daily chart on Apple and seeing what has gone on here over the last week or so. And what you can see is Apple had a pretty significant run higher. Notice how it got above the 200 and then started to pull back. Now, this is one of the key lessons in this video today. Always remember, when a stock breaks above or below on a closing basis of a major level, in this situation, the 200 moving average, it does not mean it's a breakout. In fact, what I call it is a fake breakout. It's a breakout that the institutions are doing to get the suckers like other people, such as yourself potentially, to get in the long side on Apple. All right, so the average person is going to look at this and say, oh, it just closed above the 200. This is going to go way higher. They buy. What happens? The stock goes down, they lose their money, they end up having to sell for a loss. How do you know? Well, there's something called the confirmation signal. It's a proprietary developed key here that I put together. And I'm not going to give you much insight into it because, again, it's proprietary. Those members here at In the Money Stocks know exactly what we're talking about. But what you need to look for is a secondary confirmation of a break above the 200. So here you got the first close. Great. That's the sucker's close. Now look for a secondary signal above that. And if you can do that, if you get that, then yes, it does say it's going to go higher. If it just closes once above, it usually is a fake out. How do you know it's a fake out? When it closes above after a long run. So if you look at Apple, right, Apple was trading around 108 bucks, 106 bucks right here, and it basically went nonstop up until that level. Just a small pullback here, a couple small pullbacks there. When you have an extended move on such a big company like Apple, and Apple's the biggest market cap in the world basically, when you have that type of situation and it closes above, that's 9 out of 10 times going to be a fake breakout. In fact, I've oftentimes shorted a stock like Apple when it does that and it breaks above the 200, knowing that it most likely will not confirm and therefore reverse. That's exactly what Apple did here. And again, as you can see clearly, Apple started to come in and then collapse today into the 20 moving average. 20 MA is going to be support. We'll see if it holds. I ultimately have more downside in Apple penciled in. There's a key gap fill right here with the with the 50 moving average. That's my short-term target on Apple at about $114.50. So it doesn't mean it's not going to get a one-day little bounce here or so, but ultimately you will see this in the next week or so head down into the 50 moving average and that gap fill at $114.50. Once it gets there, then we need to start watching to see what pattern forms. That'll tell us the next big move coming. All right. Next, I want to go to something on the spiders, guys. So let's go back to the intraday 10-minute chart, and I want to show you this because the markets are at a major pivotal level here. And you can see the markets are floating up, very light volume, 33 million. Look at the volume candles over here. Look at compared to yesterday. Yesterday we saw some good selling. Today there's not really any selling. Look at how light the volume is and how it's just floating the markets up ever so gently. So that's expected. That's what I told the intraday stock chat at InTheMoneyStocks.com before I stepped off the microphone earlier today. I said, listen, volume's dead. Expect a neutral to upside bias on this market. Potentially, I think we go test this high today, which is the high from yesterday before the closing last candle sell-off on the 10-minute chart. But the key I want to bring to you guys is this trend line right here. This is the trend line you want to follow. See this upsloping trend line? In fact, I have a better gauge of it here. If we flip over to this chart, it's a little bit more of an accurate line. And you can see how the chart here on the spiders, which is the S&P 500, keeps hitting that level, piercing it, bouncing, hitting, bouncing, piercing, bouncing, hitting, bouncing, piercing, bouncing, and so forth. That level is major. I want to show you on the 60-minute why it's major and how far it goes back. Look at this. You have to literally go back to September to find where this trend line starts, and look at how amazing this is. Take this gap down high pivot, connected to the secondary high pivot, connected to these pivots, all these pivots along here. Look at this. Boom, 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 boom. And then you finally broke above it, retraced quickly into it, and then went above. Notice how we're back to that line. So my point is this. If you want to see more downside on the market, on the S&P, or whether you don't want to see it, this is going to be the pivot point that you're going to follow, this trend line. All right, so basically what I'm saying is at some point, if you break below this trend line here, and especially on the daily chart, meaning at the end of the day at 4 p.m., if you close below this trend line, I would expect immediately further selling in the coming days, and quite a bit. In fact, short-term target would be down. Probably short-term target would be like 205 and a quarter, and then maybe as low as 202. Actually below 202 right here. There's a gap fill as well. But point is, this is the trend line to watch. I want to also show you something on the daily that confirms this even more. So here's the same trend line on the daily chart. But look at the necktie that's formed, the two moving averages. When you have a 20 moving average that crosses the 200 like that, it usually creates a little bit of support there. In fact, a lot of support. And that is also coinciding right below the same upsloping trend line that we're watching. You see the trend line right here, connected highs, all these little highs, and then we broke through, and now we're retesting it on the downside, and right below it you have this moving average area. So again, folks, I repeat, if this market is going to break down, and it's a big if it's going to break down, the market has to get below on a closing daily basis this trend line, and you need to ultimately close below these two moving averages as well, which is all in the same vicinity. We're all within 50 cents here on the SPY, or about 5 points, 10 points on the S&P 500. That is unbelievably key. This is the key, folks. I'm giving you literally the keys to the city, the keys to everything. Watch this. Again, you want to learn more. You want to start becoming proficient in this. You want to learn the PPT methodology. Come take the free trial at inthemoneystocks.com. That's inthemoneystocks.com. Take the Research Center free trial. It's free, folks. It's a no-brainer. Take care.